Hi everyone, a very good evening to all of you. Pranjal Arora this side from Educating. I welcome you all to today's live webinar on income tax budget, where we will be discussing the key income tax changes proposed in the 2025 Union Budget. On February 1st, 2025, our Finance Minister presented the Union Budget, outlining several important tax reforms. Whether you are an individual taxpayer, a business owner, or a financial professional, understanding these changes is a crucial aspect. Today, in this session, we'll be breaking down the new tax proposals, examining their potential impact, and answering your questions to help you navigate this year's budget with confidence. Let us start today's session with an introduction of our speaker, C.A. Sachin Sinha. Sachin Sinha is a fellow member of the Institute of Chartered Accountants of India, having 20 years of experience. He is a founder partner of Prakash Sachin and Company Chartered Accountants. Sir has enhanced experience of taxation. Also, he has developed himself in advisory and litigation and handling other commercial issues as well. He has also handled various assignments of advisory, litigation, and compliance both in direct tax as well as international taxation. So, he's also deliberated in around 400 seminars and webinars so far on the topic of domestic and international taxation and written many articles as well on the same subject. He is also a member of the study group of Direct Tax Committee in the year 2020-2021 and a member of group formed by ICAI for writing revised guidance note on tax audit. Sir is also a member of the International Tax Committee of ICAI in the years 21-22 and 22-23 and a member of the Direct Tax Committee of ICAI for the year 23-24. So this was a short introduction of our today's faculty. So we'll now start with the sessions, and any queries that you might have, you may drop in the chat box and all the queries will be catered after the session. Over to you, sir. Thank you.
Good afternoon to all. Thank you so much, Pranjal, for brief introduction. And I'm very much thankful to Educating for giving me this opportunity to deliberate on a very important topic, that is the union budget and understanding the provisions of the respective budget. So as you all know that since the budget has been presented by the Honorable Finance Minister on 1st of February, it was her 8th budget in a row, and it was itself it creates an history. And apart from this, this budget has touched upon, I think, almost every category of person in India. Either it's a low income group or a high income group, or either it's an individual, either it's a corporate, MSME, startup, either it's a marine sector, either it's a semiconductor or electronic sector. Everywhere they have tried to touch upon. Apart from this, they also touched upon the provision of TDS to give some rationalization in respect of deduction of tax, decriminalization of the provisions, like penalty provisions and the prosecution provision, that is also decriminalized. So they have tried to showcase that yes, the department is now relying on the taxpayer, and the taxpayer's word would be considered as the final word unless there is something else comes up. So with this background, I'll like to share my PPT and then I'll start discussion on the topic. Is this visible to all?
Yes, sir, it is visible.
Thank you. So whenever we talk about the budget, the first things which comes up in our mind, that what are the tax rate for this year. So this is the financial year, this budget is for the financial year 25-26. So the tax rate would be applicable for the financial year assessment year 26-27. So if you see the tax rate earlier, till last year, the rate was in the 3 multiple, like up to 3 years, it was nil, not exempt. It was nil actually. INR 3 to 7 lakh, it was 5%, 7 to 10, it was 10%, and then 10 to 12, it was 15%, and then 12 to 15 was 20%, then 15 lakh and above, 30%. So this was the slab which was given applicable for last year. So 25-26 assessment year it was applicable. And for this year, they have come up with new idea and giving more benefit, creating more slabs. So up to 4 lakh it is nil, 4 lakh to 8 lakh it is 5%, 8 lakh to 12 lakh it is 10%, 12 to 16 lakh 15%, 16 to 20 lakh 20%, 20 to 24 lakh 25%, and 24 lakh and above 30%. So earlier, if you remember, earlier the slab was for 7 categories. Then last year they changed it for 6 categories, and then this year again for 7 categories. So this is the tax structure for the individual, and individual in this case they're not categorized that individual having more than 60 year or more than 80 year. So for all individuals. And if you talk about whether the question will definitely come whether the old regime will still continue. Yes, old regime is still there. If the person opts for the old regime, then the tax rate would be different. The tax slab would be different. This is also very important to discuss that yes, what are the other benefits in respect of tax rate. So we have discussed since the budget was deliberated, the finance minister herself discussed about this, that up to 12 lakh there would be no tax. And the prime minister was so excited while the finance minister was reading this or announcing this budget, that the 12 lakh up to 12 lakh there would be no tax. So how that 12 lakh would be calculated? So just try to understand that there is a section 87 a relief or a rebate is there, which says that if the income of the person, the total income of the person is less than 12 lakh, there would be nil tax. So they have calculated the tax rate by saying that 25,000 till last year to 25,000 tax would be 0, and this year it becomes 60,000 tax would be 0. So similarly, it increases from 7 lakhs to 12 lakhs. So it means if the person having income, the total income up to rupees 12 lakh, there would be nil tax because of section 87 capital A. If the person having income of, let's say, 13 lakhs, then this 87A would not be available to him or her, and then in that case the tax would be calculated in the normal provision as per the rate prescribed here. So this is this rate would be applicable. The second catch is if this if the person who wants to avail this, there should be no special rate item. So assuming the person having total income of, let's say, 20 lakh rupees, out of this 10 lakh is the capital gain income, and as you know that capital gain, assuming it's long-term capital gain is subject to tax at the rate of 12.5%. So in that case, 12.10 lakh will be subjected to tax at the rate of 12.5%. The remaining 10 lakh would be calculated as per the slab rate, and in that case, no 87A capital A benefit would be there. So this is only applicable when there is no special rated item, because in case of a special rated item, you are anyway claiming the lower tax rate, because generally special rates are lower tax rate. So no double benefit would be available to you. Coming to the next, because these are all, so this is in case of rates what we discussed as of now, but this is all important because this will affect to most of the citizens or residents of India. And the second, which is important, is that the government has also announced that the government has to forego the tax of approx 1 lakh crore for a year or every year with this announcement. But they are ready to take up this because they know that there are other sources from where they can generate the revenue. Like, as you know, that in case of GST, government generally approaching to around 2 lakh crore per month. So this is 1 lakh crore foregone of tax in a year. So this is a win-win situation for government also, because when the person will getting more money in his hand, he will, of course, he'll try to spend that money. So his purchasing power will increase or his investment will increase, and through this the government can earn the indirect tax. So it's a compensated loss in other way. The third, which is important, is as I mentioned in the beginning, that government has tried to cater this year. This year tries to cater every aspects of the organization. So IFSC is the most important or the dream project of our Honorable Prime Minister. It is so while doing so, the government has on year to year they are announcing some benefit provision in this section. So this year also they have come up with 3-4 rationalization benefit, and if you here these are which is listed here, like extended sunset clause. Earlier it was subject the sunset was for 2024. It is extended to 31st March 2030 in a row. Now every year in this provision is not required to be given in the finance bill. They have make it applicable for up to 2030. The exemption for IFSC insurance officers also, because as you know that 1010D benefits is available when we get the insurance benefits. So this is applicable in case if the insurance company is providing the service from the IFSC. The ship leasing in IFSC, this is actually they tried to make this in the alignment with the aircraft leasing units. So assuming there is an entity which is in the ship leasing. So if they lease the ship to an entity which is in IFSC, then the same benefit would be available which is available to the aircraft leasing, and in case of capital gain, dividend, these are all exempt. Dividend definition they have also changed in case of IFSC also. So advancement of loan between the intra-group, generally it is considered as the dividend in respect of section 222 E. It's a called deemed dividend, that if the company which is advanced any loan to another company and there is the shareholding in one person in one company is more than the threshold of the in the second company also, then it is considered as a dividend. So they have said this in this case it is not considered this. So they have modified this definition to that extent, which is also a benefit in the hands of the SSC. And IFSC will definitely through these provisions, IFSC can boost their business. Simplified regime for fund managers for IFSC. IFSC is always in the list of the government, as I mentioned since beginning, and it's a continuous development because things are getting changed, and if they want to invoke more tax or more stringent provisions in case of IFSC, the non-residents or the foreign company would not be interested to invest in India, and then the whole purpose would be defeated. That's why they're trying to rationalize the provisions and giving some exemption and to the IFSC, so that they should be motivated to do some more investment in India. And rationalization participation condition, earlier it was they have changed this. So earlier the 5% of the Indian participation limit is eligible in case of investment funds. So if the 5% is there, so this is the two dates which is where it is to be tested, that is 1st of April and 1st of October. On these 2 dates, what is whether the participation is less than 5% or more than 5% needs to be tested. Now they have given a bracket of 4 months. So for first period, starting from April to April, May, June, July, this is the 4-month bracket where 5% needs to be tested. And similarly, in case of the second part, October, starting from October, November, December, January, these 4 months, the 5% needs to be tested. So basically, they have exceeded the compliance window, and through this can be tested. This is one provision. The relaxed condition is the second part. The other condition for eligible investment funds can be relaxed, and that is the operation, that is the fund managers, which is available to them. That relaxation is up to 2030. Till then, it is available as of now. The government may come up with subsequently to increase this 2030 to some more period, but as of now, it is applicable for 2030. Expanded exemption, yes. So earlier 10(4)(e) was available to them. Now they have added one more provision, and they say that the exemption under section 10(4)(e) is extended to the income arising from the transaction with foreign portfolio investors, that are the units of IFSC. So any income which is arising from the transaction with the foreign portfolio investor, that will now consider as an exempted income in the as per the provisions of section 10(4)(e), but that is in respect of only IFSC units. More boost to IFSC units by giving this reallocation of funds. So generally, what happens when the funds are relocated from one place to another place by or one entity to another entity, then it is subject to tax or the transfer triggers. Transfer is defined in section 247 of the Income Tax Act, and in that case, transfer triggers, and it is subject to capital gain. But they have made an amendment in section 47 7A, and by saying that if it is if this exchange if it is done for the purpose of IFSC, now including the either through the retail scheme or the exchange traded fund, then in that case it will not be considered for the purpose of, it will not be considered as transfer. So in that case, the tax neutral position is there because one entity is gaining and is selling and the another entity is buying. So in that case, if the satisfy the condition as mentioned in section 47 7A, then it can be considered as an exempt transaction. So not falling part of the transfer. So exemption for retail scheme also. So as we discussed, so 10(4)(e) we discussed just now. So similar benefit is given in 410D, but that is in relation to exchange traded fund, where the retail schemes and exchange traded fund regulated under the IFSC Act has already been granted income exemption under 10(4)D. So that is already covered there. Investment in sovereign wealth fund and the pension fund. This is also important to understand that sovereign wealth fund and the pension fund that are and other specified persons, another specified person to make eligible investment that is extended to 2030. Earlier it was up to 2024. Now they have extended it to 2030. So if any person who is investing in this sovereign welfare fund or any pension fund, they will get the benefit. Capital gain also, whether it will, if I sell this, whether it will be considered as capital gain. So long-term capital gain, including those assets treated as a short-term capital gain under section 50AA are exempt for the purpose of SWF and PF. So basically, this is also out of the capital gain. So again, just to boost the investment and to give the benefits, more benefits to the investor. So the benefit is not in relation to only the tax rate, which is given in the first slide. So that is also applicable where if the SSC is getting some more benefits in some different provisions, that is also increases his size of the pocket, and the SSC can buy some goods or services or more goods or services or invest to make some investment to get some future return. As you all know that the government is very keen for the semiconductor unit, and in India they have setting up the plant, and they believe that if they set up the plant in India and if the Indian company is providing or manufacturing this, they definitely need some foreign party services. So when we talk about the foreign party services, if the foreign company or the foreign person who is a non-resident providing any service to a entity which is or electronic entity, electronic manufacturing facilities, any services to an Indian entity or to a non-resident entity, in that case, whatever services they have given, whatever amount they are earning, that is subject, their income would be the deemed income of 25%. So assuming their revenue is, let's say, 100, so 25 would be their the income that will be deemed as an income, and on that amount the 40% tax rate would be applicable. So that will come to 10%. That will come to 10%. And the most importantly, in this section, if the SSC wants to declare some lower profit, that is not available to the SSC. So in any case, SSC cannot declare any lower profit, because this is all in relation to services. If the SSC is providing services, they believe that the service profit is more than 25%, but they are considering it only 25%. So pay 10% and enjoy. The second question may definitely come to your mind, that if the non-resident is providing service to an Indian entity or to any entity who is involved in electronic manufacturing and facilities in India, in that case, whether that service can should not fall in FTS, so fee for technical services, as mentioned in section 917 of the Income Tax Act. So in that case, technically speaking, yes, that will be a foreign a fee for technical services, and that will be subject to tax as per the provision of section 917, chargeable to tax as per provision of 917, and subject to tax as per the rate prescribed under section 115A. But this is not this transaction will not fall under this, or there is no overlapping provision, because this is applicable only when there is a when the foreign entity has a permanent establishment in India. If the foreign entity having a permanent establishment in India, they are supposed to declare their income as a business income. And when talking about the business income, there's a revenue, and out of this there is a certain expenditure, and the net profit is subject to tax. So it may so happen that the expenses are more than the revenue, and in that case, there is loss, or there is lesser profit, and the profit is less than 25%, and the SSU wants to declare the lesser profit. So department says no, whatever the revenue is there, we will consider as 25% as your profit or as an income, and on that 25% of 40% rate would be applicable. So the effective tax rate would be 10%, of course, plus surcharge plus education cess. Inland water transportation, government is very keen to get some foreign investment, or to get some foreign players in India to carry on their business. And for this purpose, there are certain benefits they have already given. And as you all know, that there are tonnage tax, which is also there in the statute. But that tonnage tax is applicable only when there is an outbound ship, or inbound ship, that is in relation to if the ship is coming to India or going outside India, then only this provision would be applicable. Now the question arises whether similar type of scheme can be given to inland water transportation. So assuming the goods are moving from Kochi port to Kolkata port, or from Kochi port to Goa port. So it's there's no foreign water involved in it. And in that case, whether the similar benefit what they have given through the tonnage tax, that benefit can be given in the case of the domestic water transportation or inland water transportation. So considering that fact in mind, they have come up with the provision by saying that inland vessels will be eligible as a qualified ship under section 115 BD, aligning their definition with the Inland Water Vessel Act. So in the Inland Vessel Act, they have already defined and the inland water transportation and the outbound transportation. So they have covered this, and the tonnage tax which is also there, which is also there. So now it is applicable in case of the inland waterways. Charitable trusts, as we discussed earlier also, that charitable trust is the biggest area of working in India. And there are so many charitable trusts in India who are working significantly, but there are certain charitable trusts who are even not able to get any grant, or getting grant with the lower amount, or if they are carrying on any business or activities in India, the revenue size is very low. But as you know that since last 5-10 years, the government has keep on changing the provisions or relating to charitable trust, and there are so many provisions they have inserted, and that is in relation to the compliance part. And if a person who is carrying on a charitable trust, they needs to do so many compliances, whether there is any revenue or not. So which is actually the burdensome on those type of entities who don't have the charitable receipts or the charitable income. So government has tried to understand this issue, and when the presentation were made by the stakeholders, the government has tried to incorporate that in their finance bill to give the benefits to the entities or to the charitable institutions who are genuinely want to carry on their business, but due to certain reason they are not able to carry on a business as of now. So whether they are supposed to do the same compliances what the other entities or the big charitable institutions are doing, the answer is no. So in that case, they have tried to give some relief to a charitable trust. So the situation arises, how the situation arises. So the law says the PCIT or CIT can pass an order in writing for cancelling the registration. So this is in respect of cancellation of registration. If he is satisfied that there is one or more violations has taken place. So the idea is there should be no violation, and in any case, but what if there is certain violation has taken place, and as I mentioned that in case of small charitable institutions, sometimes there is no professional who are working. They are working with some other person who are not a professional, and in that case they are not able to guide their client properly. So the question arises, if they fill up the form for the regularization of the institution license, and if there is any fault or any violation is there, or if there is any false information they have given, then how to tackle that? Because that there may be a mollified with the information which is given are incorrect because of the mollified intention, or that are all given because they are not aware about the full fact, or they are not able to understand the layout of the form, that what information needs to be shared. So in that case, whether it is a specified violation or not, because a specified violation is already defined in this act. So if this is so, they'll try to understand that whether it's a minor default or a specified default. So generally, if I fill up a form and I miss to put some information, or I put it wrongly or in the wrong head, does it lead to cancellation of my registration? The answer would be no. If this is so, then how to handle? So government has said that okay, we will consider this. Application, and if the application for registration or trust are not complete, shall not be treated as specified violation. So if the specified violation takes place, then the registration would be cancelled, and whatever amount is lying on that will go to the another charitable institution. So to avoid this type of situation, they said, okay, we'll consider it. We'll consider it that you have filed the information in a good faith, so it will not be considered as a specified violation. Period of registration of smaller trusts. This is also a big challenge for the smaller trusts, because whenever we talk with the smaller trust in charge or owner, they say there are so many compliances needs to be done, and we are not so big organization who get daily or who has a good fund flow in the institution. In that case, whether how to do the renewal, because one man has to depute and the consultant has to be hired for this. So at the expiry of the registration or provisional registration, the activities of the trust is coming, the trust is required to make an application for further registration. So now my one period is going to over now. Now I have to make an application to the department that I have started my activity earlier. For these 5 years, I was activity were taken place earlier, and now they want to carry on renew the license. Then in that case, they said, okay, if the receipts is less than 5 crore, then the 5 year would be the 5 year additional 5 year period is given. So now you can renew your license within 10 years. So the 5 year needs to be tested. 5 crore needs to be tested. In which year 5 crore has attained? If in the beginning there's less than 5 crore, but subsequently it exceeds 5 crore, then how to test it? So if it is more than 5 crore, then of course the period would be 5 years. Harmonization of SCP, this is also important aspect. So while talking about the SCP, this is in relation to basis of charge, and the section 9 covers this section 911 explanation 2A, which was inserted in 2018, and the notification in this regard which comes in the year 2021. So since then this section is applicable. Now the question arises that whether this section is applicable on the purchase of goods also, because if the person if the Indian person is purchasing goods from a foreign party or from a non-resident, and that person is selling all its good to an Indian customers, then whether it is a business in India or business with India. So technically it is business with India and not business in India. So in that case, it is said that if any transaction or activities of a non-resident in which India is confined to the purchase of goods in India for the purpose of export shall not constitute as SAP. These are the conditions that the goods are purchased in India for the purpose of export outside India. And if you remember, Section 911 explanation 2 talks about the similar thing, but 2A, this provision was not aligned with 2. So 2A was not matching with 2. So now they had said, okay, we will now by inserting this amendment, they said that okay, this now 2A, explanation 2A and explanation 2 are aligned. Startup is the brainchild of our honorable finance minister, honorable prime minister, and since then the government is when the government took charge in 2014, they started working on this startup concept, and I think 2016 they rolled out with the provisions relating to startup. And they have given so much of benefits to the startup as of now, and there are certain sections in the Income Tax Act which they have given for the purpose of to give the benefit to the startups. So when the first thing which is whether how to get the startup registration. So so these are all the procedural part. The important thing is an entity which is started, they are registered after 19 sorry, after 19 and before 1st April 2025, then they are all under they are eligible to take the benefit under 80 ISC, but there are other conditions also. So, and year on year, if you remember, on year they're increasing it by 1 year. Now they have increased it for 5 years, so make it 2030. So any person incorporated its company on or after 2019, but before 1st April 2030, so he is eligible, that entity is eligible to take the benefit of reduction under Section 80 ISC in 3 year, in any consecutive 3 year out of 10 years from the date of its incorporation. So assuming the company incorporated in 2020 and now they want to take the benefit. So yes, they are eligible to take the benefit because they are satisfying all the conditions. And that 3 year is available to them consecutively to take the benefit. TDS provisions has changed a lot. So if you remember in the July 2024 budget, they changed the tax TDS rate. There are 4-5 sections where they have changed the tax rate from 5% to 2%. In case of commission, it was 5% to 2%. In case of rent, it was 5% to 2%. So they have made a good amount of changes in it, and in the July budget, and now they have come up with the increase in the threshold, because all the thresholds which are given in these particular sections are since beginning, or we can say that it was not changed in last 10 years. So it actually needs to be changed because the income level of the person has grown up. So if you see the interest on securities, which is Section 193, earlier there was no threshold. So assuming the person who is getting interest on securities, let's say 20,000 rupees, that is subject to tax, withholding tax. But now they have made it 10,000 rupees. So assuming I am the person who have invested interest, who is getting interest on securities, in that case, if the income is up to 8,000 rupees, no tax, no withholding tax. If it is more than 10,000, then of course the withholding tax would be applicable. Similarly, they have made a very good change in Section 194 capital A. This is interest other than interest on securities, and generally the saving account, generally the account FD interests are come under this. So it was earlier the two categories were there. Earlier, the rupees 50,000 for senior citizen. And the second provision was the 40,000 in the case of other, when the payer is a bank, cooperative society, and post office, and the 5,000 in other cases. Assuming I have made some investment in the fixed deposit in SBI and getting, let's say, 6% of interest. So assuming my investment was, let's say, 50 lakh rupees, and I was getting interest, let's say 6%. So it is around 3 lakhs approx. So earlier, up to 50,000, there was no tax. Now, in case of senior citizen, they have increased it to 1 lakh. So it's a good amount of good amount of increment there. So as earlier, if the interest amount is 60,000, then they have to pay the bank or the payer has to deduct the tax. Now they've increased it to 1 lakh. In case of other payments from the is from bank, cooperative society, or post office, it was 40,000. It increased into 50,000, and the 5,000 in any other case. Now it becomes 10,000 rupees. So assuming I'm making some investment. So I'm not a senior citizen. I'm making some investment in bank and I'm getting interest from it. So it says that yes, earlier up to 5,000 it was nil, and more than 5,000, yes, it was subject to withholding tax. So now it is, in case of, if it is exceeding 10,000 rupees, then only it is subject to withholding tax. Individual shareholder dividend, in case of dividend also, it increases from 5,000 to 10,000. Income in respect of units of mutual fund, that is also increased from 5,000 to 10,000. Winning from lottery, crossword puzzle, etc. So earlier it was 10,000. Earlier it was 10,000 during the year. So if the person is taking 2-3 lotteries from different companies, and he is on that lottery, and he is supposed to get the money, then if the aggregate is more than 10,000, then only the TDS subject would be applicable, otherwise not. So now they have changed it, and let's say that the aggregation is not required if the individual or the particular organization or the company is giving less than 10,000, no need to deduct tax. If it is more than 10,000, just deduct the tax as per the price provision of 194 capital A. 194 double B, which is 194B. 194 double B, that is winning from horse races. If you remember, in the last year, it was inserted in the act, and so it says whatever amount they have earned, so on that the TDS would be applicable. Now they have removed if it is more than 10,000, then only the TDS would be applicable. Commission, if you remember, in the previous budget, they have changed the rate of tax from 5% to 2%. 5% to 2%. Now they have changed it. And now they have increased the threshold from 15,000 to 20,000. And commission or brokerage, the tax rate also changed from 5% to 2%, and the minimum exemption increased from 15,000 to 20,000. Rent, this is interesting in case of rent, and I think it is widely applicable in most of the cases. So earlier it was, if the rental income is more than 2,40,000, then the payer has to deduct the tax, withhold the tax. Either it is the rate was given in section 194I. So whatever amount is given, that was the threshold of 2,40,000. They have now increased it to 50,000 per month. So generally, it's a general understanding that it is applicable for there is no tax up to 6 lakhs. So this is not the fact. So the tax would be applicable if it is more than 50,000 rupees rental income. So assuming I took a property on rent for 4 months, and the tax and the rental amount is 60,000 rupees. Rental amount is 60,000 rupees per month. So it is again 2,40,000. So whether the tax is required to be deducted or not, then in that case, the TDS is earlier provision. The TDS is not required to be deducted because it is not exceeding the threshold 2,40,000 rupees. But now in this case, the TDS is required to be deducted. So it's a monthly affair now. 194J, this is also important to understand and widely applicable on most of us. So earlier the threshold was 30,000 rupees. Now it increases to 50,000 rupees. And while talking about the fee for technical services, it include that is applicable for royalty also, for FTS also, for directors fees also. On all cases, it is applicable. So most of the directors who are getting some remuneration, they may get some good amount of benefit here, because the money will directly flow to their account and no tax is required to be deducted till the amount is 50,000 rupees. Enhanced compensation. Just a minute. There is one change in TCS provision also, and in case of TCS provision, it says that if you remember earlier, there was two provision. One is for TCS and another is for TDS. The TDS was under section 194Q, which says the payer has to deduct the tax at time of making payment at the rate of 0.1% if the purchase amount during the financial year exceeds 50 lakh rupees. So these are the condition, and the person who is paying the tax are subject to tax audit. There is more, the turnover is more than 1 crore, etc. These are the provisions which was there in case of TDS provision section 194Q. Similar provision or the replicated provision was available in 206C1H. So the question arises that do I need to do both? Because 206C1H says that if the person is receiving money, then in that case the TCS would be applicable. So one person is paying and another person is receiving, and now this and they're saying that if you are paying which is more than the threshold limit, then and if you satisfying the condition, then you are required to deduct the tax under the provision of 194Q, and the similar right given to the pay to the buyer also, and says that if you are collecting the money, so it is so similar provision given to the seller also, because you are collecting the money, so add 0.01% and collect more and deposit to the government account. Now the question arises, who will do what? So basically, so whether do I need to deduct TDS, or should I leave it because the TCS would be applicable in this case, or how do I come to know that whether the TCS is applicable or not? So in to remove all this ambiguity, and they said, okay, let's do one thing. Remove 206C1H and let it be 194Q. So now 194Q is applicable only, and no 206C1H. One more provision is related to TDS. So if you remember, there is section 206C CA. So in case of TDS, there is a 206AB, and in case of TCS 206 CCA, which says that the person is non-filer of return on or before the specified date, then the tax rate would be higher in this case. The tax rate would be higher. It means the deductor has to deduct the tax at the higher rate and not at the standard rate, which is available for all. But the challenge was, how do I come to know that whether he has filed a return or not? And nowadays, filing of return, whether it includes only 139(1), or it can go up to 139(4), 5, 139(8)(a), etc. So these are all challenges there. So this because it is real genuine problem for a payer, that how he should and when he is supposed to know, and what are the evidence he has to keep with him, that yes, he is a filer or a non-filer. So these are all big challenge, and the department started sending notices to the payer that you have not deduct the tax properly and the person is a non-filer. So at the time of purchase, how do I come to know that whether he's a non-filer or not? So in that case, the government has said, okay, remove 206AB and 206CCA to avoid all this complication. You are free to do the business if it is exceeding the tax limit of, let's say, 50 lakh rupees in a year, even though the TCS provision would not be applicable. But in that case, on the 206 AB, but in that case, the other provision, the other deductions per provision would be applicable at the normal rate. So, Pranjal, is there any query as of now, or should I proceed further? Is there any query? Okay. So, since there is no answer, so I believe there is no query. Now come to the second part. So, rationalized definition of forest produce. This is also related to TDS, TCS basically. So, when we talk about the tendu leaves and the other items, so the term the forest produce was also there, and the TCS would be applicable at the rate of 2.5%, and it applies to the sale of timber and other forest item. So in that case, the issue arises that what is the meaning of forest produce, and from where a person who is collecting the tax is from where he will get the true meaning of the term forest produce. So in that case, and there are certain judgments also in which it was decided, but now they have amended the provision. Now they said the definition of forest produce is aligned with the Indian Forest Act. So now they have clearly mentioned that whatever is the provision given in the Forest Act, that will be considered for the purpose of forest produce or relevant state law. TCS now applies only to forest produce obtained under a forest lease, excluding traders selling produce without such a lease. So this amendment basically clarifies the meaning of forest produce, reduce compliance burden we just discussed, that the TCS provision under section 206C1H is removed, eliminating double tax collection when the buyer is required to deduct tax under section 194Q. This is another big relief for an individual. Just try to understand what actually what benefit the individual can get out of this. So if you remember, there is a provision in section 23, if I'm not wrong, 23, 24. There are certain benefits which is given in case of house property, and which says that the person having one house property is always considered as a self-occupied property, and their annual value would be considered as nil. What about the second house property? The government, the provision says that if the SSC has a second house property, which is also they're living in that property, or they're not living in that property by any reason, so and they're not let out that property, so whether the standard based on the standard rent, can it be deemed that they are earning income, and based on that income the tax is required to be calculated. So the technically as of now, yes, the provision says so. So in case of 23(2), section 23 under bracket 2, read with 23(4), it says if you have a one house property, which is always be considered as a self-occupied property, subject to that is not let out property, number one. Number two, if you have another house property, then you have to give a reason that why you are not residing in that property and why the benefit of the second house is to be given. So the answer is, if the person is not residing in that city, or not residing in that city because of his job position. So assuming the person is a resident of is somewhere else because of his job or because of his business, and the second property is at the different place, then in that case it will be said that okay, it is also considered as a self-occupied property, but the idea is to give you have to give the justification and the explanation that why the reason should be logic, the reason which is mentioned in section 23 under bracket 2, that needs to be satisfied. Now they said, okay, if you are owning 2 house property or more than 2 house property, the 2 house property will be considered as a nil, as a standard value of nil. It means it's considered as self-occupied property. And for this purpose, there is no reason needs to be mentioned that why I have another property and why I'm not living in that property, and why the tax or the proposed tax should be applied on me in this case. Requisition of block assessment. This is also an important aspect because now we are moving towards the administrative part. So just let me run through one thing, that whether is there any charging provision is still pending. So charging provision we have done. Now just try to understand the block assessment for search and requisition cases. This you all know that this is I think 153, not wrong. 158B, 158. Then in that case, so this said 158B is basically gives the definition part, and they includes in the undisclosed income as a virtual digital asset also. It means if the person is dealing in a virtual digital asset and not residing in that, dealing in the virtual digital asset, and there is search in this case. So the question arises, if the search is taken place, whether the virtual digital asset should also be part of the undisclosed income. So now, yes, the answer is yes, it should be part of the undisclosed income, and on that income also the department can go for the assessment. The second important part is the abatement of the pending assessment. So provision regarding abatement of the assessment are clarified to align with the search and requisition initiation. So basically, rationalization and the idea is to give the benefit to the investor or the assessees, so that they can focus on the business, and any tax part issues, no need to go for regular compliances. Subsequent searches, computation of income is also very important in this regard, and there is another section which is section 155 under bracket 21 is inserted, and for the purpose of computation. And I'm sorry, that 155.21 is for transfer pricing provision. So for this, computation of income is already given, that is undisclosed income, and the time limit for block assessment is also extended to 12 months from the end of the quarter in which the last authorization of search was requisition was executed. So time limit also increased. This was already in discussion earlier, that whether the penalty would be because the penalty provision is still continuing, and however the main provision is now not applicable. So they said section 271 AAB is not applicable to searches initiated under section 132 on or after 1st September, because in the last budget they come up with this amendment that 132 would be will continue only up to the 1st of September 2024. So, but there's the corresponding amendment which was supposed to be there in the previous year itself, that was not there. So they have made this correction this year. Search and seizure also a very important part. So they have made a certain change, the time limit for obtaining approval to retain the seized books of accounts is also amended. The term execution of such an authorization for searches or requisition is updated to the reference of 158B instead of 158B, and that is for the block assessment. So this is also the new provision. The time of imposing penalty, this is again a big challenge for the department, because for every case they have to relook that what is the timeline to impose the penalty. And this creates a quite burden on the department officials to keep the track of issuing the penalty notice or imposing the penalty within the timeline, and that timeline needs to be tested every time. So now they have rationalized this by saying that the time limit for imposing penalties is standardized to 6 months from the end of the quarter in which the connected proceeding are completed. So assuming your connected proceeding is completed in January, so you have time of up to September. So January, February, March is a quarter. So quarter will end on 31st of March, and then 6 months. So it will go up to September. So now they've given more time to the department to issue your notice and to do the justice by issuing the notice, because nowadays what happened when they are issuing the notice, they're even not bothering that what the SSC has submitted the reply because of the work pressure. They generally issue the notice so cause, and if the so cause notice is not replied within the given time frame, they'll issue they pass the main order or the final order. So through this, therefore, they'll get some benefit of time in this case, and since they have some time in hand, they will properly analyze the transaction, and then only the penalty would be applied. Clarified period of for stay. So it generally happens. It also creates but a big problem for department by saying that for every time the stay is granted by the court or by the higher authorities. High authorities means assuming some tribunal court or the high court or the, so any period during that will not be counted, and that should be eliminated. So the period during which the proceedings are stayed, a court and order shall be executed in computing the time limit for further proceeding. So now they have made an amendment by saying that the period starting from the date of the stay is from the date the stay is granted and ending when the juridical principal or the commissioner receives by certified order that vacates the state. So now once they receive the order, then only the period will start, and before that, no. This will definitely create some problem for the SSC as well, because sometime it happens that the SSC, that the department has not received any intimation from the higher authorities, and the SSC is keep on approaching, and then they said, okay, if you have the copy, then submit it, and then we will pass the order accordingly. But now it clearly says that the receives the copy of the order that vacates the stay, and from where it is to be obtained, or how the assessing officer can get this order. These are all important aspects. Carry forward of losses. This is also another important aspect of discussion. And if you remember, there are certain points in case of section 72 where it says that the person, if any company or entity carrying on its incur any loss in a particular year, then that loss can be set off in 8 consecutive years, so within 8 consecutive assessment years, and that loss can be carried forward to that period. But what if the company which incurred loss in 4 years back and now getting merged with another company? So earlier, the date of the period of this 8 year shall start from the date of merger, and the SSC will get first 4 year or 5 year, let's say 7 year benefit, and then subsequently go for 8 years more. So now they said, okay, to remove all these things, because the SSCs are getting more benefit, they say, okay, if this is the case, then that 8 year is to be calculated from the end of the year in which the notice is issued. Sorry, the merger took place. So once the merger took, assuming the company incurred the loss in the year, let's say 2022, and now they are getting merged with some company. So in that case, from 2022, there's the year in which the loss incurred. So it is available up to 2010, because up to 8 years, so 20 or 30, because of the 10-year, 8-year period that is starting from 2022, from the year in which the loss was incurred, and not from the period in which the merger takes place. transfer pricing provision, this is also important to understand that what are the changes has been made in the transfer pricing. As you know, that in case of transfer pricing, there are most important thing is the preparation of the study report, which needs to be submitted to the AO when they require this study report at the time of assessment. So this generally happens that there are similar kind of transaction year on year, and the SSC is preparing the document, and the SSC is preparing the document every year because it's a provision of law. So in that case, they said that if the nature of business is similar, if the AEs are similar, and if the other factors which can influence the price are same or similar, then in that case, the SSC is not required to prepare that document every year, and they can approach to the department for this. So this is an optional thing which is given. So that is an option of the SSC. So if the SSC wants to avail this benefit, the SSC has to file an application before the assessing officer, which will go to the TPO, and then TPO will refer it and then send it back to the AO, and then AO can allow this. So the ALP determined for the transaction in 1 year can apply to the same transaction in next 2 years. So assuming I have determined ALP in the year 2024, so and there is no change in the business, so it will continue up to 2025 and 2026 also. But for this, I need to check. We need to submit to the department an application. This we discussed that higher TDS or TCS in case of non-filing of return. Updated return. This is also important part. Updated return. While talking about the updated return, how it works actually. So section 139(8)(a) was there, if you remember, and in that provision, there's a 2-year period was given. So 24 months period from the end of the assessment year. So once the assessment year is over, then from that for the 24 months period is given for the purpose of filing of the updated return. So assuming you find that you missed something to report to the department, or you missed to file the return, and you don't want to come in the non-filer category, then you need to file a updated return. So the time limit was earlier 0 to 12 months, and then 12 months to 24 months. So if you are filing within 12 months, then 25% additional tax subject to be given. If you're filing that updated return after 12 months, but within 24 months, then 50% of the additional tax is to be given. Now they've given more periods, so 24 months to 36 months, then the additional 60% tax is to be given. And if it is more than 36 months, but of course within 48 months, then so filed within 36 to 48 is missing here, 48 months, then 75% is to be given. So if the SSC wish to pay almost double of tax, then he can wait up to 4 years. But why the SSC will go for this, assuming I don't have any tax, but I forgot to declare my income under, I forgot to declare certain item like let's say foreign property, which is, and I'm if I do not declare that foreign asset, then I have to give the penalty under the Black Money Act also. Though to avoid all this situation, the SSC, what the SSC can do, SSC will calculate some amount of tax, let's say 10,000 rupees, pay additional tax, let's say 7,500. So because 75% would be, so around 17,500 pay, or 20,000 odd number pay as tax, and declare all the asset in the 4th year return also, if you missed to declare it earlier. So this can also be done. But these are the another challenges which will come, that nowadays to send the reassessment notice is 3 years from the end of the relevant assessment year. So what if the SSC, the department has issued the notice under 148? Can the SSC again go back and file a updated return? What if the SSC has filed the updated return as well as the main return, then or the return under section 139(1), which ITR will be selected for the purpose of scrutiny? Because in the updated return, the information is not required in as detail as which is required in the main return or the revised return. So these are all certain points which create some challenges also. And of course, there are apart from this, there are number of changes are there, but for the we have not covered here because of the considering the interest of the audience. Because if we go for the national saving scheme from the taxation or NPS Vatsalya, there are certain amendments also, but these are not we have taken only those points which is applicable on the masses. But to my mind, if I can submit that, if I can rate the budget this year, I can say that yes, out of 10, 8 is the number which I can give, which I would like to give to the Honorable Finance Minister. So this is all from my side. If there is any query, I am ready to take it. Pranjal, is there any query?
So allow me 2 minutes, I'll update you just right now. So I cannot see any queries as of now. Hi everyone. In case if you have any queries with respect to the session that's just delivered right now, you may drop your queries in the chat box below, and sir will cater to the queries one by one.
Okay. So can I conclude here?
So I think we should just wait for 1 to 2 minutes in case if
Okay.
someone ends up dropping a query, and then we can conclude the session.
Okay.
Okay. Sure, sir.
Thank you, Varun.
So there are no queries, but we have received a few comments, and we'll be sharing the comments with you just right now.
Okay.
So the comments are there in the chat box. So I think we should conclude the session now, considering the participants don't seem to have any query.
Okay. Thank
Yes.
you so much. Thank you so much, ma'am. And thank you to all for your patient listening. I'm again very much thankful to Educating for giving me this opportunity. Thank you so much.
Thank you so much, sir. It was pleasure having with you us again. Thank you so much.
Thank
Thank you, everyone. I hope you all had a great session.
Thank you.
Thank you. Good evening. Bye.